Welcome to this explainer. If you're looking for efficient, focused learning that gets right to the point, well, you're in the right place. Today, we're taking a seriously fascinating journey. We're going to connect a legendary, yet surprisingly simple investing philosophy to the absolute biggest macro shifts happening right now. I'm talking about the AI infrastructure boom, the nuclear power renaissance, and the new regulatory landscape for digital assets. I know it sounds like a lot, right? But stick with me. As we go through this, you'll see exactly how they all tie together through one incredibly powerful economic concept. Okay, 921%. That is the staggering cumulative return generated by Nick Sleep's Nomad investment partnership over just 13 years. That completely blew global equity markets out of the water. But you know what the craziest part of this achievement is? It wasn't just the return itself, it was how he did it. By the later years of his fund, Sleep had concentrated his entire portfolio into essentially just three stocks: Amazon, Costco, and Berkshire Hathaway. He completely ignored the market noise, he avoided constant trading, and instead, he zeroed in on one very specific type of business model. Let's dive into this. There's this famous quote from Amazon founder Jeff Bezos that perfectly captures the exact philosophy Nick Sleep was looking for. Your margin is my opportunity. See, Sleep realized by companies like Amazon and Costco weren't designed to maximize their short-term profit margins. Not at all. Instead, they were built from the ground up to compound value continuously through scale. While most investors back then looked at early Amazon and just saw a massively unprofitable retailer, Nick Sleep looked at it and saw a system deliberately engineered to become an unstoppable compounding machine. To understand exactly how this works, we need to look at our foundational framework. Act 1. The Nomad investment strategy. So Nick Sleep sought out founder-led businesses that were playing a totally different game, something he called scale economics shared. It's basically a system where a company uses its increasing scale to drive down costs. But here's the kicker. Instead of keeping that extra money to artificially boost their quarterly profits, they intentionally reinvest those savings right back into lower prices or better value for their customers. It's all about long-term structural compounding. I mean, Costco does this by capping their markups at around 14 to 15%, and Amazon did it by constantly slashing prices and pouring billions into faster logistics. And this brilliantly illustrates the self-reinforcing flywheel that powers these businesses. It goes like this. Step 1, achieve scale to lower your operating costs. Step 2, pass those savings directly onto the customer. Step 3, customers absolutely love the lower prices and better value, so they respond with intense loyalty and higher purchasing volume. And then step 4, that massive volume gives the company even greater scale. Now they can negotiate better supplier terms or build better infrastructure, which lowers costs all over again. It creates this incredible loop that makes it virtually impossible for competitors to catch up, at least not without suffering years of massive losses. So, how does this legendary framework apply to the modern market frontier? Well, that brings us to Act 2, the AI infrastructure arms race. Today's tech giants, who, let's be honest, are already absolute masters of scale, are currently engaging in a massive capital expenditure cycle. They're building out the infrastructure required for artificial intelligence, and they're doing it at a scale that pretty much guarantees they remain the dominant platforms of the future. But there's a massive bottleneck right now: electricity. To train and run these advanced AI models, you need data centers, and a medium-sized AI data center consumes the equivalent electricity of about 100,000 households. Traditional renewable energy simply cannot provide that 24/7 baseload power reliably at this scale. So what's big tech doing? They're turning to nuclear energy. Meta has committed to securing up to 6.6 gigawatts of nuclear capacity. Microsoft is literally spending $1.6 billion to revive the 3 Mile Island nuclear plant. Amazon has secured a multi-gigawatt nuclear pipeline. They are spending tens of billions of dollars just to guarantee their infrastructure scale advantage. Because of this, we're actually seeing an entirely new commercial real estate asset class emerging, driven by small modular reactors, or SMRs. See, traditional nuclear reactors require a massive physical footprint, easily over 1,000 acres. But SMRs? They can literally be built in a factory and assembled on parcels as small as 35 to 50 acres. And since data centers desperately need to be near this power, we are seeing incredible land value appreciation within a 25 to 50-mile radius of these planned SMR sites. Industrial land, power corridors, even workforce housing in these areas, they're all suddenly becoming premium real estate plays. And it's really important to note that this isn't just some corporate initiative. It's heavily backed by federal policy. Recent executive orders from the Trump administration aim to dramatically expand U.S. nuclear capacity, taking it from 100 gigawatts today all the way to 400 gigawatts by the year 2050. This represents a massive, multi-decade wave of site selection, construction, and commercial real estate development. The modern masters of scale are essentially locking in the physical infrastructure of the future, and it's being fully supported by national economic security priorities. We've talked a lot about the physical infrastructure needed for modern scale. Now let's pivot a bit. Welcome to Act 3, Regulating Digital Asset Scale. Just as AI desperately needs reliable power to scale safely, digital assets, specifically stablecoins, need clear legal infrastructure to actually achieve public trust. Enter the highly bipartisan Genius Act, which creates a really clever dual-track framework for this. On one hand, you can become a federal qualified issuer that's approved by the OCC, it preempts state licensing, and it gives you absolutely unlimited capacity to scale. On the other hand, smaller issuers can opt for a state-qualified route, overseen by a certified state regulator, but they are strictly capped at $10 billion in outstanding issuance. Once they hit that cap, they have to transition to the federal framework or get a special waiver. It's a structure perfectly designed to ensure that as these digital currencies scale up to systemically important sizes, they have the right federal oversight. Now, what's truly fascinating here is how strict the consumer protections actually are. This law is specifically designed to guarantee economic security. Issuers must back their stablecoins on a strict one-to-one basis with highly liquid assets like cash or short-term treasuries. No exceptions. They have to provide monthly attestations checked by a registered accounting firm. They are strictly prohibited from rehypothecating, which is just a fancy way of saying they absolutely cannot gamble with customer funds. And most importantly, if the issuer goes bankrupt, the law grants stablecoin holders super priority status. That means customer assets are totally insulated and paid out first, before any other creditors. This is exactly the kind of regulatory infrastructure needed for digital payments to truly scale globally. All right, that brings us to our final section, Act 4, Concentration versus Broad Exposure. So we've seen how massive companies use scale economics shared to build these incredibly deep moats across AI, nuclear, and digital assets. But the big question is, how do you allocate your capital? Let's look at two of the most popular ETFs out there. First up, the Invesco QQQ Trust, which tracks the NASDAQ 100. It is heavily concentrated. A full 50% of this fund is in technology alone, with another 29% split between communication services and consumer cyclicals. When you buy this fund, you're essentially making a concentrated bet on the exact mega-cap growth companies we've just been discussing. The Microsofts, the Amazons, the Metas, the very companies driving the entire AI and infrastructure arms race. But, as we all know, concentration brings both higher rewards and higher risks. Let's compare QQQ to Vanguard's S&P 500 ETF, VOO. VOO offers broad market exposure across 505 companies. It is incredibly cheap, boasting a 0.03% expense ratio compared to QQQ's 0.18%, and it actually pays a higher dividend yield. But crucially, look at the max drawdown over the last 5 years. VOO dropped about 24.5%, while the tech-heavy QQQ dropped over 35%. On the flip side, of course, QQQ boasts a significantly higher one-year return. It's a classic trade-off. VOO gives you stability and broad diversification, while QQQ gives you a concentrated allocation to growth leadership and those modern masters of scale. So the crucial point is this. Regardless of which path you ultimately choose, we have to remember Nick Sleep's ultimate lesson. For his wildly successful fund, the real edge wasn't predicting macroeconomic cycles. It wasn't executing perfectly timed trades. His actual edge was doing nothing. Once you find a compounding machine, a business actively building durable advantages through scale and delivering massive customer value, the hardest part of investing is simply having the patience to hold it, uninterrupted, for decades. As we wrap up this explainer, I want to leave you with a question to ponder for your own portfolio. Take a good look at your allocations. Are you investing for the safety and stability of broad market exposure? Or are you making a concentrated bet on the mega-cap tech giants and the modern frontier of AI, nuclear infrastructure, and digital scaling? There's absolutely no single right answer here, but understanding the underlying economics of the companies you own is always the first step toward long-term wealth. Thank you so much for joining me to explore this today. Keep learning and keep looking for those compounding machines.